Hello, a very lovely good evening from here in Delhi, and hope as always that each one of you are absolutely fine and, of course, in very fine spirits. So, coming today to the what we call directly towards the business end, just to actually tell you that we are going to start today a chapter which happens to be a pretty formidable one, but unfortunately, actually, I have seen student fraternity neglects this particular chapter and doesn't actually realizes the importance which this particular chapter really commands. Cash flow statement, cash flow analysis, in fact, actually, I'm talking about. The name of the chapter happens to be cash flow analysis. It's a very formidable chapter. And in my opinion, to be very honest with you, I will rate this particular chapter at much higher level, even in comparison to what we call India's 103 and India's 110. Why? The reason being is very simple. Because more often than not, especially if you are going to scan the regularity of of the questions which are being actually tossed up from this particular what we call chapter is pretty high. The intensity of this particular chapter remains very high in the eyes and in the minds of the examiner. Since the advent and introduction of the new syllabi, if you will notice the what we call past examinations papers, you will find that almost in every examination you are having a question from this particular what we call chapter. But this is not only the what we call fact. The important fact is that the question which they toss up in the examination generally commands 12 marks, and at the same time it happens to be a compulsory question. So here you cannot simply what we call escape the heat of this particular question. So that is why actually I'm saying that it's a pretty formidable chapter, and at the same time I'm cautioning you that you need not require to what we call neglect the importance of this particular topic and chapter both. At the same time, name of the chapter happens to be cash flow analysis, but I'm not quite what we call um, yeah, I'm not quite able to understand the logic behind that, because name is cash flow analysis, but here actually we are supposed to command a very strong knowledge of the past standards, that is existing accounting standards, which we have already studied in our what we call past phases of education. And besides that, actually we need to command a very high amount of knowledge with respect to Ind-AS, needless to add. And above all these, we need to have a very strong base of Schedule 3 Division 2. If we can really think that we are in a position to solve the questions, so we need to have all these three what we call bases at our command virtually, so as to actually solve the question in a very easy manner. So that's the reason actually why this particular chapter commands a little bit high rating, at least in my eyes. And after going through this analysis, I'm sure it should command what we call high rating even in your eyes too. So at least after having gone through these words, you must have realized that in order to actually have a good grip over this particular chapter, name is cash flow analysis, but I've already told you we need to have a very strong base of what we call all the past standards or existing standard as we call them, and the Indias and the Schedule 3, especially Division 2. So in my opinion, the name of the chapter should have been actually financial statement analysis, because here what will happen in the examination, we shall be given a question, correct, and you will be asked to detect the errors and rectify and prepare the revised financial statement in the light of the what we call NAS. So that is why I'm saying that it's a pretty strong what we call chapter. However, if we can somehow manage what we call all these things which I just told a moment ago, a good base of existing accounting standard and Indias, and at the same time if we are very deft with the Schedule 3 of Companies Act, of course 2013 I'm talking about, and especially with respect to Division 2, then it should not pose much problem at the same time. But only thing is that we need to actually put a little bit of efforts. So how to go about this? Now we come to the business end and start a discussion. Now, this is the sheet I have put up before you, correct? So, here is the sheet, and Schedule 3 to Companies Act 2013. So, I just want to actually, even though I know very well, because those among you actually who have already done our lectures and subscribed to our courses, they must have realized that when we were doing what we call consolidation and business combinations over there, we almost in every question, wherever needed, we adopted Division 2 itself. And In this regard, actually, I always presume that by now you should be actually a little bit more proficient with respect to Division 2. But in spite of that, actually, because this is going to play a very important role later on in solving the question, that is why I want to have a little bit of discussion just to actually remind you and recap the things which we have already done. Correct? It is of paramount importance, actually, that you need to understand that. Although right now at this particular moment I'm talking about Schedule 3 Division 2, at the same time I'm presuming that you all have the what we call sort of knowledge which we expect of the student of your level regarding the existing accounting standard which you have already gone through in your past phases of education, and at the same time Ind AS. That is very important that you need to have a very strong base and foundation of the all the Ind ASs which are part of your syllabus. Correct? So now we come over to this particular point. Here we go. And in this case, we find that Schedule 3 to Companies Act 2013 Division 2. So I come straight away. Correct? These are, of course, note numbers. These are what we call current year figures, and these are past year figures. But we are not going to talk about what we call column 2, 3, and 4. What I am interested in is that you need to have a little bit of knowledge with respect to what we call component and the frame and the headings and the subheadings. As you know, these are assets, and by now you are very well aware that under Division 2, first of all, we give priority to the assets. First, assets will be written. Then, under the assets, we are going to write non-current assets. So, this is non-current assets. Under non-current asset, by now, each one of you are very well aware. Property, plant, and equipment. Before I move further, let me also give you some motivating what we call um, tips, because why this particular chapter has been made a part of your syllabus. Reason being is that here the examiner is under a presumption that you all have become CA, to be very honest with you. So they simply want to test your knowledge that when you are going to enter into the practical arena, how well actually you are deft up with the financial reporting aspects. Correct? So, in fact, this chapter is nothing but a culmination of all the things which you have already done under your financial reporting. So, it is a real test of your knowledge. Correct? So, and even you can I can bet my hair on it that later on when you are going to actually enter into the practical arena, so often your clients will come out with what we call balance sheets and all, wherein you will be asked to actually detect the errors, rectify the same, and give a what we call proper explanation regarding the same, how to actually put them into the proper perspective of the financial statements. So anyway, here we go and start. Non-current assets, property, plant, and equipment, each one of us know. Then capital work in progress. Then investment property. Now this is a new entry. Investment property we have done under Ind AS 40. You understand it very well. If I'm going to ask you what exactly the investment property, and I sincerely hope that you all are well aware of it, because we are expecting that you have done all your Ind AS now and you are well chefed up with it. So investment property is a property actually which is held either by the owner or by the lessee, and here their purpose or intention is to earn some capital appreciation or rental income. So if I have kept any property with me for the purpose of capital appreciation or for the purpose of earning some what we call rental incomes, then it is what we call classified as investment property, and as you can see it is written as a separate line item. Interesting point is goodwill. Correct? We have first written goodwill. The interesting point is that after that we have written other intangible assets. As we know, in basic, what we call intention of the entire plethora of Indias is they stress more on the disclosure aspect. Correct? More on the disclosure aspect, because in the opinion of the what we call Indias, an entity can what we call give the what we call information in a truer and fairer manner only when as much as disclosures are made. So indirectly what I want to actually put the point into your mind is that, because so often we easily neglect this, we think it's goodwill, it's okay, it's goodwill, other intangible assets. You need to have a note of this, and you need to inculcate this habit of looking over even the minutest possible aspects, because so often later on when you are going to enter into your practical arena, especially, you'll find that in many big companies they are going to toss up questions before you, such as this one. So goodwill now has been actually made a separate line item, and other intangible assets are collaborated in one single heading, other intangible assets. Other intangible assets comprises, as each one of you know, just for the sake of your knowledge, like brands, trademarks, computer software, mastheads. Mastheads, do you know what is masthead? When you read the morning newspaper, the headline, which you, not exactly headline but the title, for example, I'm reading Indian Express, then the Indian Express is the masthead, is equal to, like, similarly Hindustan Times, Times of India, the Pioneer, or whatever newspaper you actually go by. Correct? So mastheads and publishing titles, copyrights, patents, similarly intellectual rights, services, operating rights, recipes, formulae, models, design and prototypes, licenses, franchise. So all these will be corroborated into other intangible assets. But the important point is that goodwill is not made a part of intangible asset. It is shown as a separate line item. Similarly, under non-current asset, we have already gone through property, plant and equipment, capital work in progress, investment property, goodwill, besides other intangible asset. Now the next one is actually intangible assets under development. So you can see now that even intangible assets which are still under development or development phase need to be reflected separately. Biological assets other than bearer plant, we have gone through these two aspects. Biological assets basically means biological animals and biological plants. And when you were studying in day 16, you must have noticed over there that we talked about this particular aspect that biological assets are not considered as a part of property, plant, and equipment because there is a separate standard by the name of Ind-AS 41 for the same. However, bearer plants are considered as a part of property. As a part of property, plant, and equipment, but even over there, there was some exception, if you remember. Bearer plants are considered as what we call property, plant, and equipment, but agricultural produce on the bearer plant is not considered as part of as part of property, plant, and equipment. Correct? But anyway, just to it's a sort of recap. I have already told you. Financial asset, it's a new entry. Why this new entry? Because three new Ind AS, that is Ind AS 109, 107, and 32. Because among the existing accounting standards there wasn't any what we call or I should say there isn't any what we call any standard dealing purely with the financial instruments, because among the existing accounting standard 30, 31, and 32 haven't been actually notified. Remember one thing, they haven't been notified. Only 29 are notified existing accounting standard, and accounting standard 30, 31, 32, although they deal with financial instrument, but they haven't been notified. So that's why I'm saying so that as far as existing accounting standards are concerned, there isn't what we call any standard which deals with the what we call financial assets. So that was the reason that under the what we call existing accounting standard, when we used to prepare the balance sheet, we hardly ever came across an item by the name of financial assets. But now under Ind AS, it is virtually a force. Correct? It is virtually a force. So we have to make space for what we call financial assets. So that is the reason that under Division 2, we find that a new entry has been made. So under non-current asset, we also have financial asset, and it is very important, especially when you are going to tackle the problems of cash flow analysis. You need to have a very good knowledge of financial assets. You need to actually keep in your mind that financial asset comprises of investment, because we are right now going through non-current assets. So it means here we are talking of investment, means we are talking about long-term investment. Similarly, what we call trade receivables and loans. Correct? So all these comprises of financial assets. So financial asset basically is a corroborative of these three items: investment, trade receivable, and loans. We can say so. Under non-current asset, then item number I relates to deferred tax assets net. You must have gone to Ind AS 12, and you must have known by now very well that deferred tax assets and liabilities can be offset with each other. That is why we always write the word net. So if the amount of deferred tax asset will be high, it will be presented towards the asset side, and provided it is payable after 12 months, because then only it will appear under non-current asset. If it is payable within what we call, say, in a period which is less than 12 months, then it will appear as an item of what we call current assets. But here we are right now, what we call dealing with non-current assets. So deferred tax asset net means actually the difference between deferred tax asset and that deferred tax liability. Then last item happens to be other non-current asset. Generally under other non-current asset, we will write capital advances and advances which are other than of capital nature. Correct? So capital advances means actually, suppose I have given any advance for what we call some capital projects. It is a sort of capital advance. Correct? Then we come over to the what we call current assets. So as far as current assets are concerned, each one of you are very well aware of this particular fact that it comprises first, of course, of inventory. Each one of you are also aware that inventory need to be reflected under different formats, that is finished goods, work in progress, isn't it, or not, raw material, etc. Then financial assets, once again, because financial asset was also a part of non-current asset, quite obviously now it will also become a part of current asset. And here, when we write actually investment, it means it is investment of current nature. Then trade receivable, and then I come over to the next sheet. That is sheet number 2. Cash and cash equivalent, correct? Bank balance, please pay attention. Cash and cash equivalents. You have already gone through Ind AS 7. You understand the meaning of cash. Cash comprises of cash in hand and demand deposits. And what exactly cash equivalents? Basically, short-term investment which we can realize. Of course, at a short notice, you can say generally a period of 90 days we consider. So if an amount can be realized within 90 days after giving notice, and we are not going to lose anything, and that way no penalties will be imposed, then it is considered as a cash equivalence. Then bank balance. Here, bank balance means the amount which we have kept in what we call banks, other banks, RBIs, foreign banks, or other branches. So these are bank balances. Remember one thing, all these are part of financial assets which are of current nature. Then loans. If you have given loan in the form of, say, security deposit, you have given some what we call amount as a security deposit. It's an asset, but it will be considered as a what we call current asset, provided the period is lesser than 12 months. Then loans to related parties, and if any other sort of loan, the loan need to be actually categorized into what we call security deposit, loans to related parties, and uh, others. So these are the items which are part of, after inventories we did what we call financial assets under the current asset I'm talking about. And under current asset we have already seen there are so many items. So that is investment of current nature, then trade receivable, then cash and cash equivalents, then bank balances and loans. Correct. Now under the current asset, first item is inventory, then financial asset, and then there is current tax asset. I've already told you current tax asset is nothing but deferred tax assets, provided it is of current nature. Correct. Then similarly, other current assets. So we went through what we call other non-current asset, where we talked about capital advances. Similarly, other current assets here it includes actually advances other than of capital nature, because generally when we give the what we call advances for the capital nature purpose, generally it is for a longer period of time. So that is why these are categorized as other non-current asset. But here I'm talking about advances which I have given for a purpose other than the capital nature. Correct. Similarly, if I have given any advance to the director of the company, or the directors of the company, or officers of a particular company, so these will be categorized as other current assets. So this is what we have for as far as asset side is concerned. Correct. Now we move over to equity and liability side. Under division 2, equity and liabilities is written later on, that is after having written all the assets. Then equity and liability quite obviously comprises of two items, one equity and liability. That is why we have written first equity. As you know, and we wrote so many times under consolidation and both under business combination. Remember one thing, you need to write here equity share capital. It is very important. At least if not for the examination purpose, at least you need to know that tomorrow if you become a professional and in the interview, especially by the big companies, they are going to put up such questions. You can really keep my words. So that is equity share capital. We are not writing here share capital. That means under Ind AS we do not write share capital. We write only equity share capital. But does it mean that we don't write preference share capital? No, that is nothing like that. Heading will be equity share capital. If preference share capital has equity element, then it will be put up over here, because preference share capital we have seen under financial instrument that it could have elements of equity and it could have elements of liability both. So that is the reason, first of all, you need to understand equity share capital doesn't mean that we are going to write here equity share capital only. Any financial instrument of equity nature we are going to put it up over here, but the name will be equity share capital. Other equity, as you know, herein we put up what we call reserves, other earnings, retained earnings, etc. Then we come over to the liability, equity and liability. Under the liability, we shall have two liabilities, non-current liability or current liability. Now, first we pick up non-current liability. As far as non-current liabilities are concerned, here we have financial liabilities, and I'm stressing upon financial liabilities, financial assets. So financial liabilities basically comprises of one, borrowings, second, trade payables, and third, other financial liabilities. Please pay attention. Financial liability has financial liability has three important elements. One, borrowings, second, trade payables, and third, other financial liability. Or should I say this way now? As far as non-current liabilities is concerned, broadly non-current liability is categorized into three parts. One is financial liability, correct? A. B is provisions, and C is, where is C? C is deferred tax liability, and D is other non-current liability. Please pay attention. Non-current liabilities are divided into four parts broadly. One is financial liability, as I said. Second one happens to be provisions, correct, which we have written over here. Then deferred tax liability and other non-current liability. These are the four broad classification of the liability or subsegment of the non-current liability. Now, we take segments. Financial liability. One segment of non-current liability is financial liability. Now, there are even financial liability comprises of some segments like borrowings, trade payables, and other financial liability. Under the borrowings, if you have issued any bonds or debentures, you are going to put it up over here as borrowings. And remember, borrowing is a part of financial liability. Likewise, you have taken any term loan. Term loans means loans which you have procured on some conditions, and generally the term loans are basically for a longer period of time. So if you have taken the term loans either from the banks or from what we call other parties, you need to present it what we call as a part of financial liability under the subhead borrowings. Similarly, deferred payment liabilities. Deposits. These are the deposits which others have deposited with the entity and entity is supposed to pay them. Loans from related party. Similarly, liability component of compound financial instrument. This was the point which I was trying to tell you earlier. So it is a very much possibility that a financial instrument may command what we call elements like equity and liability both. So the equity part will be written under equity, while liability part will be written under liability, obviously. And you need to understand that liability part, where it will be written over here. Is it clear to you or not? So under non-current liability, main segment is financial liability. Under financial liability, there are three segments: borrowings, trade payables, and other financial liability. You need to keep a track of borrowings. So we have done the first major segment, financial liability. Next one is provisions. Provisions means if you have created any short-term long-term provision for employee benefits or any other sort of provision, it will be presented over here. Then similarly, deferred tax liability. Deferred tax liability net, now we have written. So it means the amount of deferred tax liability is higher in comparison to deferred tax assets, and that amount is payable after a period exceeding what we call 12 months. That is why it will be considered as a non-current liability. Remember one thing, we are analyzing non-current liability. Non-current liability has got what we call four important part. One is financial liability. Second is provisions. Third is deferred tax liability. And fourth one is other non-current liability. Like other current assets, similarly, other non-current liability deals with advances. Only difference is that under assets, you have given the amount and here you have received the amount. That means if you have received some advance income because you have written something in advance, you, obviously it should not be said that it is an income because it is a sort of liability. That is why you are going to put it up over here. Besides that, if you have received some any other what we call advance amount, you are going to put it up over here. Then we come over to what we call current liability. So by now you should be familiar with this particular fact that as far as non-current liability is concerned, it has got four components. One is what we call financial liability. Second is provisions. Third is deferred tax liability. Fourth one is other non-current liability. Correct? These are four parts of non-current liability. And the first part is important. Among these four parts, first part is financial liability, and financial liability comprises of borrowings, trade payables, and what we call other financial liability. It is very important to understand and retain, of course, at the same time. Then current liability. Here, under the current liability, first of all, we are going to write financial liability. Financial liability is similar to the similarly, what we call financial liabilities under non-current liabilities. Here we are talking about financial liabilities which are of current nature. It will comprise of borrowings, correct? Borrowings here will include loans repayable on demand. Similarly, deposits which you are supposed to pay within a period less than 12 months. Similarly, any other loan which you are supposed to pay very shortly. That mean for in a period which is lesser than 12 months. Then financial liability besides borrowing will comprise of what we call trade payables. Then I come over to the next sheet. This is sheet number third. Third component is other financial liability. We are talking about financial liabilities which are of current nature, correct? We talked about what we call borrowings. We talked about trade payables. Now we are talking about other financial liabilities. This item is very important. Under current liability, the first segment is financial liability. Financial liability comprises of borrowings, as I said a moment ago. Beside it will comprise of trade payables, which is not going to give us any jitters. Now the third happens to be the other financial liability. As far as other financial liability is concerned, see here, and you need to actually please try to retain them. Current maturities of long-term debts. You might have issued some debenture, correct, for 10 years period. Now, the debentures are repayable because you have almost reached the end of the 10th year. So let us say within next month you are supposed to pay the entire amount. So that means it is the current maturity of the debt. It will no more be treated as long term. It will be treated as short term, and it will be written here under other financial liability. Similarly, current maturities of lease obligations. Why I didn't what we call read finance, because as you know under Ind AS 116, from the perspective of the lessee, actually leases are no more classified as finance lease or operating lease. So that is why you better simply write current maturities of lease obligation. You have taken what we call some items or asset on lease, correct, wherein you are supposed to make the payment because you are the lessee. And if your payments are going to fall within a period of 12 months from the end of your current reporting period, obviously, then such portions of the payment will be treated as of current nature and it will be treated as what we call part of other current liabilities. Then, similarly, any unpaid dividend. And if you have received some application money on the shares or securities which you might have issued, correct? And that portion is refundable simply because of the fact that you could not allot the securities. So that portion which is refundable, of course, will be treated as liability. It will find place under the other financial liabilities. Similarly, unpaid matured deposits. So deposits might have matured, but due to some or other reasons, you might have not paid them. So you will have to pay them now because you have defaulted. You will have to make the payment of interest also. So unpaid matured debentures and along interest over there also. So these are what we call items which you are going to write under other financial liabilities. So first segment we talked about under current liability. The first segment is financial liability. Financial liability comprises of borrowings, trade payables, and other financial liabilities. Correct? Is it clear to you? Three items under the financial liability. So under current liability, first one is financial liability. Second one is other current liability. Other current liability. Other current liability means suppose if you have received some advance or any other sort of advance, correct? Then you are going to put it up over here. Besides, then provisions. Amount of provision again, that means if that provision relates to a period lesser than of 12 months from the end of your reporting period, like provision for employee benefits, correct, provision for depreciation, etc. Whatever sort of provision which you have created, if they are of shorter duration nature, then you are going to put them over here. And the fourth part of current liability is current tax liability. Again, it is a difference between deferred tax asset and deferred tax liability. But only thing is that the period of payment is less than what we call 12 months. So these are the things which you need to actually know, especially if you happens to be a professional level student. I have seen actually many students simply neglects all these things. So this is a very bad picture in the sense later on I can pet my hair again, time and again I'm saying so, because when later on you are going to enter, and especially uh, whenever you are going to have some face off with the uh, people whom count a lot, I mean say especially the interviews or in some what we call good discussions, you will definitely find that these are the things which are cropping up during your discussion, and as a professional you need to have an answer to it. Now, just to recap the things, first we did the assets. We have seen that asset comprises of non-current asset, wherein we wrote property, plant and equipment, capital work in progress, investment property, and I have explained investment property. It is a property that which is kept for the capital appreciation purpose or for earning rental incomes. Similarly, it comprises of goodwill, then other intangible asset under development, biological assets, then financial asset, and I have written in bold once again. I'm recapping the things. Financial asset comprises of investment, trade receivable, loans, and others. Similarly, then deferred tax asset and other non-current asset, which means advances, correct, which you have given for capital purpose or some other purpose. These are your non-current asset, then current asset classified into inventories, then financial asset. Financial asset, now you should be familiar with the fact, deals up with current investment, trade receivable, cash and cash equivalent, and balances, loans, others. Similarly, next one is current tax asset and other current liability. Under equity and liability, we write first equity. Equity comprises of equity share capital and other equity. Don't write share capital. Then liabilities, non-current liability and current liability, of course. This is your next sheet. Under non-current liabilities, we write financial liabilities. I'm simply summarizing the things which we have done, correct? And no financial liability, I talked about, that comprises of borrowings, trade payable, other financial liability. There are many items under borrowings and financial liability which you need to be very well aware of. Then provisions, deferred tax liability, and other non-current liability. Then we shall talk about current liability. As far as current liabilities are concerned, again divided into four parts: financial liability, other current liability, provisions, and current liability. And importantly, because you have seen so often, I'm stressing upon these aspects, financial liability comprises of borrowings, trade payables, and other financial liability. Now, as a professional, you need to understand two, three things. Important points. You must have noticed that earlier we used to write fixed asset. Now we are using the word what we call property, plant, and equipment. Similarly, what we call, just to have a good matching, we have renamed, or new nomenclature as we call it. Instead of intangible asset, we are simply now writing goodwill, correct? So goodwill, and then what we call intangible assets. So you can say that tangible assets indirectly are property, plant, and equipment now, correct? So tangible assets are renamed as property, plant, and equipment because we are going to put them under the property, plant, and equipment you have already seen. Then disclosure of goodwill separately from other what we call intangibles, I have already told you. Then disclosure of biological assets other than bearer plants separately. So these are the things which you keep in your mind, especially when under what we call division 2, introduction of new head financial asset. We talked about this particular thing. Then clubbing of investments. In fact, clubbing of investments, trade receivable, loans, cash, and cash equivalent as financial asset, we also saw that. Similarly, we are under the balance sheet, we are reflecting current tax asset net, it as a separate line item, or we can simply call it that we are reflecting on the face of the balance sheet. No more we are going to use the word reserve and surplus. It is replaced by other equity, as you know. Similarly, introduction of a new head under the financial liability, and even under the what we call financial liability, we have clubbed the borrowings, trade payable under what we call financial liability. Correct? Similarly, disclosure of current liability on the face of balance sheet. So these are something which you need to take care of. Just what we call mere going through the what we call items is not enough. You need to develop and attain the edge in comparison to the others. Then only you will count. Correct? Then deferred tax asset will have to be recognized as per the balance sheet approach. So you have already gone through under Ind AS 12. Some of you might have gone through, some of you might not have gone through. So if you haven't gone through, you will realize that nowadays, while computing the deferred tax asset or deferred tax liability, we are not going to follow the income approach as was the case under accounting standard AS 22, correct? Now we are going to actually take a balance sheet approach. It is pretty clumsy, no doubt about it. But at the same time, if you become deft in it, you will definitely find it is far more easier in comparison to the earlier one. But superficially, it looks very difficult to fathom, very difficult to understand. But as I told you, once you become what we call equipped with it, suddenly you will realize, oh my God, it is so easy. Unnecessarily, we have had developed so much of phobia. Very shortly, I'm going to release a video on this in AS 12 also on the YouTube. You keep a track of it. Then long-term provisions, and very important, long-term provisions, that mean provisions of what we call non-current nature. India is always stresses upon fair value. So that is why long-term provision need to be carried at present value, not just think for a moment. Tomorrow you enter what we call into a company as a prospective candidate, and in the interview, this particular question is tossed up. So that is why I'm trying to tell you the theoretical part, like accounting framework, like what we call, these are the things, schedules, or we simply call them annexure. We so often tend to actually neglect them. You should not, as a professional student, whenever you have the time, always go through, dig deep, very deeply. It will definitely going to hold you in a very good state, as I keep on saying you, especially when we are going to enter into your practical path. Correct? So besides that, when we have gone through the balance sheet and we have taken what we call, what are the salient things which we need to keep track of, correct? Now we need to equip us a little bit what we call with respect to the Footnotes, the notes generally, or contingent liability, as you keep on saying, and the commitments. So you are very well aware of it. Contingent liability shall be what we call categorized into claims against the company not acknowledged as debt. Other parties might be claiming some amount, but we have not acknowledged that, when we have not yet accepted the fact that it is a liability for us. So that is why we are simply presenting it as a contingent liability. So guarantees excluding financial guarantees. So if you have given some guarantees, you are feeling that you may have to pay in future, but still you are not very clear that there will be outflow. That is why, first of all, you are going to present it as a contingent liability, because contingent liability means on the balance sheet date there you are under an obligation, but you are also under an impression that there will not be any outflow of the funds. So that is why you are not recognizing it as an item of liability. Rather, you are recognizing it as a what we call contingent liability. So any guarantee which you have given besides the financial guarantees will be presented over here. Similarly, other money for which the company is contingently liable. Contingently liable. For example, you might have entered into a business combination wherein you might have committed yourself with the what we call acquiring entity, that after acquiring you later on, what we call after say 5 years, 4 years, we are going to pay some more amount. So here you are contingently liable, but contingently basically means something which depends upon some other factor. For example, the agreement with the acquiring company, you are the acquirer, the agreement with the acquiring company is that we will pay you, we will make the payment initially, but also there is a clause, let us say in the agreement, that we will pay you after 4 years some amount, provided the profits increase by 10%. So this extra payment depends upon this factor, increase in profit. So if you have committed yourself, you have entered into your what we call an agreement with somebody, and where you feel that some amount you may have to pay, so it will be reflected. So other money for which the company is contingently liable. Commitment shall be, and commitments, one is what we call contingent liability, second is commitment. So estimated amount of contracts remaining to be executed. So this is your commitment. You have, let us say, taken some construction, a project, construction of a bridge or toll plaza or some very big infrastructure. Let us say 75% portion is completed, but 25% is still to be completed. You have to mention it and disclose it by way of notes. You tell me very honestly, how many times you have gone through these notes? Never. Let me tell you. That is why I keep on telling. Go over each and every line. Don't think it is clumsy. Even by applying a little bit of mind, you will be able to understand perhaps better than I. Correct? Because you have a sharper brain than I. I have high amount of experience. That's a different point. I sincerely agree. Because after having reached what we call 52, 53, quite obviously I cannot claim to have a sort of brain which uh, people less than of 30, 40 years of me will have, quite obviously. So uncalled liability on shares and other investment partly paid up. You might have made some what we call investment somewhere, correct? And so far you haven't paid the full amount of that investment. Let us say you purchased 1000 shares, for simplicity's sake, let us say of 100, but so far you have paid only at the rate of what we call 70, because that particular company, investing company, has called up only 70. So that means there is a liability for the unpaid amount, because it hasn't yet been called up, but it may be called up in future. Then other commitment, if any, you will have to specify. As you know, besides that, we also prepare a statement of changes in equity. A statement of changes in equity is also prepared in two parts. One is equity share capital, wherein we are going to reflect the what we call changes in the equity share capital. Correct? So these are the things which we generally write. This is sheet number 4. I will keep the sheet number 5. Don't worry, just let me settle the sheets a wee bit. We'll keep these sheets over here. This sheet number 4. 1. So many sheets are lying here and there. Correct? Besides that, as far as changes in equity is concerned, I need not require to tell you actually that in the opening balance we will write. And if any changes have taken place on account of what we call issuance of the share, on account of buyback of shares, we shall adjust it before writing the what we call closing balance. Correct? That means whatever balance is written in the balance sheet, you need to disclose actually how you have arrived over this particular balance. Similarly, we'll talk about other equity later on, but at this particular moment, I'm simply trying to tell you that we need to give a good presentation of other equity items that you had the balances, but how come you have arrived? For example, because whenever an entity prepares the financial, it presents the current year position, it also presents the past year project position. For example, last year position of retained earnings was, let us say, 10 crore, and in the current balance sheet, it is 25 crores. Quite obviously, there are many investors whom would love to know actually how come this particular amount has gone up by such leaps and bounds. So you will have to give an explanation. That explanation is given through, and you have to give that explanation because Indians would like you to do. In fact, there is a force, there is a foundation. You cannot escape this particular dictate. So that's the reason actually under other equity, one statement of changes in equity, one you will prepare with respect to what we call equity share capital, as I just told, and second with respect to other equity. As far as other equity is concerned, you will give, you don't go through this formats, don't worry about this, because many people, as soon as they will have a look over this what we call all these things, they might what we call develop in scare. Oh my god, what is this? Must be very clumsy, very tough, nothing like. I'm giving you a simple explanation. Here you will have to actually give what we call detailed analysis, that how, as I was trying to tell you, how come this item of retained earning went from 10 crore to 25 crores. So that detailed explanation will be given this way around, that whatever balance you had in the beginning, what changes have taken place in the items of the what we call other equity. So these are the items of the other equity which I have put up over here. Besides that, I have put up here some more items. For example, under financial instrument, many a times what happens, you classify a particular item into a category, fair value through profit or loss account, and many times you actually classify the items as fair value through other comprehensive income. So you will take into account their changes at every aspect. So in other words, when we say other equity, we need to tell to the investors and the users that how come the changes have taken place in the items of the other equity. But we are going to deal up with this, correct, when I'm going to actually solve the questions, but it is just a format which I have presented before you. Is it clear to you or not? So these are the things which an entity need to do when it prepares what we call financial statement. We are going to have what we call some questions, especially for other equity, correct? So don't worry about that, you will understand this format. It is just for your sake, just to what we call go through it. So as a professional level student, you need to have a good knowledge regarding this, correct? Now, basic purpose, because we are doing the chapter cash flow analysis. As you know, when we do the cash flow analysis, I told you we need to have a good knowledge, one, with respect to the existing accounting standard, second, with respect to the Ind AS, and third, with respect to the schedule and especially division 2. Under division 2, under part 1, we have gone through the balance sheet and at great length. And similarly, now we are going to talk about a little bit with respect to statement of changes in profit and loss account. However, it is not going to consume much time. The reason being is very simple, because there is nothing for me to actually tell you. This is how you are going to prepare it under division 2. It is very similar to the format which you are accustomed to. Revenue from operations, correct? And then other income you are going to take, you will add, then you are going to write the expenses. You know that there are various headings like cost of material purchase, beside purchase of what we call stock in trade, changes in inventory of finished goods, stock in trade, and work in progress. Similarly, employee benefit expenses, finance cost, depreciation, amortization cost, other expenses. So whatever total expenses are there, you are going to subtract, you are going to get profit and loss before exceptional items and tax, correct? I have written here exceptional items, then profit before exceptional items, then tax expenses, current taxes, deferred tax, etc. And then profit and loss for the period from continuing operations, correct? Then profit and loss from continuing operations, and profit or loss from discontinued operation, and tax expense of the discontinued operation. Remember one thing, the operation which has discontinued, we have to actually write their tax expenses also. Then we will get profit or loss from discontinued operation, and then we will subtract what we call these two from the what we call total profits which we earn to get profit and loss for the period. This is the important part. Profit and loss for the period simply means profit and loss for the period from what we call uh, total continuing operations. Then other comprehensive income we are going to add. This is the point which I would love to actually discuss with it. Now, as you know, nowadays we prepare actually profit and loss account, and over there, actually we can say that this is the first part. Although we are going to prepare it this way around only, just for the sake of simplicity, we may say that this is first part, and now it is a second part. Actually, in many countries, they in fact the corresponding Ind AS, in fact IAFRS, IAS1, International Accounting Standard AS1 I'm talking about, they have prescribed now profit and loss account, but they have segregated them into profit and loss account and statement of other comprehensive income. But here in India, the corresponding Ind AS, that means Ind AS1, has prescribed this format, wherein under section 1 we write items related to profit and loss, and then in the same statement we are going to put up other comprehensive income items. And you know that other comprehensive income items comprises of what we call items that will not be reclassified to profit and loss account. And similarly, then we will also write what we call any income tax relating to the item that will not be reclassified to profit and loss account. Correct? Important point is that here you are going to put up items, both type of item, whether they will be reclassified to profit and loss or whether they are not going to be classified. But important thing is that whenever you are going to write the items in the other comprehensive income or items of comprehensive income, you need to write them net of tax. That means associated tax will be subtracted, then only you are going to write here. So other comprehensive income, you will put here items that will not be reclassified to profit and loss account, and income tax related over there, you are going to put up the net figure in the outer column. Then B, items that will be reclassified to profit and loss. Under other under other comprehensive income, there are two types of item. One, we say such items which are not reclassified to profit and loss account, and one which are classified to profit and loss account. Both the items will come here, and both the items will come here at net of tax. Net of tax means by subtracting the tax from that associated income. Correct? Then we will get the total comprehensive income. By adding other comprehensive income items to profit and loss for the period, we will get the total comprehensive income. Till up to this point, you need to know, because next point is related to what we call our basic earning, diluted earnings. So important point is that you need to have a fair bit of idea regarding two items with respect to other comprehensive income, as I talked about. Other comprehensive income shall be classified into, as I just told you, items that will not be classified to profit and loss account. For example, you must have noticed that even we discussed this particular point when we did India 16, any revaluation reserve is taken to what we call OCI, correct? But from OCI, it will never ever be reclassified to PNL. Point is this. Similarly, remeasurement of defined benefit plans. As you know, for employees' sake, you take what we call benefit plan, defined benefit plans, and almost every 1 year you are going to actually do the actuarial valuation. So over there might be some gains. In the gains means your liability might have come down or reduced by, so you need to create lesser provision. It's a sort of gain. So any such gain will be reclassified to other comprehensive income. Correct? It will be classified to other comprehensive income, and once they will find a place in the what we call other comprehensive income, they will never ever move to what we call lap or profit and loss account. This is what my point. They can never ever be reclassified to PNL. So items of such nature which will not be classified to PNL are known as items that is not classified to profit and loss. Similarly, equity instruments through other comprehensive income. We have seen under what we call financial instruments when we did Ind AS 109 that especially when an entity classifies the item, correct, sometimes it classifies the what we call relevant financial instrument into the category of fair value through other comprehensive income. Now, fair value through other comprehensive income, what does it suggest? It suggests that if there would be any change, it will be taken to the other comprehensive income. So once it will find the place, when it will sit in the lap of other comprehensive income, it will never ever move out of it to the lap of profit and loss account. In simple words, I can say so, correct? Similarly, items that will be reclassified to profit and loss account. Now, exchange differences in translating the financial statement of a foreign operations. You have done India as 21. Even over there, actually, we talked about this particular point that when we translate the what we call foreign branches into the functional currency, because nowadays instead of reporting currency, we call functional currency because India is 21 stresses upon functional currency, correct? So whatever what we call differences were there, they used to be actually reclassified to OCI. But the important point is that suppose tomorrow you disposes of your foreign branch. So this balance related to the translation of foreign operation into the OCI, once that branch is disposed of, you cannot keep it over there. So you will have to reclassify to P&L. That is what we mean by items which are right now presented in the OCI, but in future may be reclassified to profit and loss account. So two types of items are there. Both the items will find place in the other comprehensive income. Important point is that whenever you are going to put up both the items, you're going to put up them net of tax. Net of tax means by subtracting the tax from relevant item income or whatever it is, then the net amount you are going to put up over there. Then we have what else? Under this, we have also written debt instrument through other comprehensive income, same thing, and effective portions of gains and loss on hedging instrument in a cash flow hedge. Now, it's a pretty strong thing because cash flow hedge is something which is very, very difficult to understand, very difficult to comprehend. But those among you who have subscribed to our courses must have seen that we have taken almost 39 lectures to cover financial instruments, correct? Now, of FR I'm talking about. So 39 lecture, and especially in the last 2 3 lectures we have taken a very long question with respect to cash flow hedges, wherein I talked about effective portions and ineffective portion, if you remember. So any such effective portion of gains or loss on hedging instruments in a cash, what we call cash flow hedge, that is, and we had seen over there at the time that that gain is classified to OCI. But because it is something temporary, because after all we are dealing up with hedges. What hedges means you are safeguarding yourself from what we call any possible future losses. That is what we mean by hedge. Hedge means safety. What exactly hedge stands for? Hedge हिंदी में बोलते हैं ना, वो घर के आसपास आपने देखा होगा कई लोग अपने घर के आसपास वो बाउंड्री टाइप से बनाते हैं, क्या बोलते हैं, पौधों की वो वॉल टाइप से बना देते हैं प्लांट लगा करके. वो क्या है? That is nothing but that is a sort of what we call hedge. Why? Just to safeguard from what we call any animal. Correct? Similarly, here we are, sometimes we enter into what we call hedging contracts to safeguard any possible future losses. So anyway, cash flow hedges. There are two terms which are used with respect to cash flow and hedges, like effective portion and ineffective portion. Right now, it is not possible for me to discuss that because even if I would discuss, you will not be able to understand. For that, again, you will have to revisit that particular lecture. But right now, at this particular moment, it is suffice to say that if there is any effective portion of gain or loss, then it is presented in the OCI. But point is that it is a temporary sort of what we call gain, because for how much duration this particular contract will keep, it is quite obviously for a shorter period. So once this particular contract is over, so quite obviously you cannot keep that particular portion of gain in the OCI. So that is why after some other point of time, you are going to reclassify into P&L. That is why it is a part of what we call items which can be classified into profit and loss. So these are the things. And just as a professional student, to sharpen your knowledge a way bit, we have seen that important. You have gone through profit and loss account. I just want to test you how many among you actually just went through it very, very carefully. See here, when I was reading, I never uttered the word extraordinary item. Didn't it surprise you? Because in earlier schedule, we are very well what we call accustomed to this item extraordinary. That means under the statement of P&L, extraordinary items have been removed. Exceptional items are there, but extraordinary items are not there. Similarly, earlier we used to write discontinuing operations, but now we will use the word discontinued operation. Correct? So these are the minor points which we need to understand a bit. And similarly, dividend on redeemable preference share, now we will have to recognize it as an interest cost. Earlier we never used to did that way, never used to do that way, isn't it? Similarly, actuarial gain or losses will be recognized in OCI. So these are the vital points. So Now we come over to a very strong question. And this question I have taken from RTP for November 2020 examination, no doubt about it. It's so this sort of question. You can see the length and breadth of this question. It is starting from this particular sheet, correct? So the moment a student actually gazes through this particular, he may develop what we call shivers. Oh my God! You can see this is the sheet, second sheet. This is moving. This is still the question is on, and still the question is on till up to this particular sheet. Quite obviously, many students think, well, it is not my cup of coffee. It is very difficult. Correct? It is better not to actually touch this particular part itself. Now, let me tell you, please don't skip the next session. And I promise you, I'm going to actually give you and equip you with such arsenal that this particular what we call case study will appear to be, as I keep on saying, almost like a stroll in the park. So, on such note, we take actually leave of you, but with a promise that you and I are going to meet both in the next session, because skipping that means you're losing out on 12 marks. So, most important, powerful discussion we are going to have had, because I'm not very fond of simply what we call red inking, red marking, and putting up a slate and simply reading it. So, this is not the way to teach what we call FR. Correct? So I just want to inculcate in you both habit of writing, understanding, having a good look over the material, and develop what we call the skills of self-study. This is how you can manage what we call greater heights, both what we call in your professionalism and in your other life too. So on such note, we take goodbye of you.